advocates are well known for their immediate commitments. Yesterday, some commitment came, he was to join us yesterday, but due to his commitment and some court matters, urgent matters, he could not start yesterday. Today morning, he left from 5 o'clock from Chennai to join us on time. And he said, very important. Thank you so much. And now from here, we will be straightway rushing to Delhi for his further commitment. Thank you so much. And Rajaratnam Sahab also, yesterday he immediately came before time during our session also, and he expressed his all interest during the session. I thank you both of you for that, and we now over the proceedings to both the honored speakers. Welcome, sir.
Good morning, friends. Good morning. It's a great pleasure for me. I've been recently, for the past few years, I have not been participating in any seminar because of my age. I've been the audience, I've been saying, scrupulously, I've been saying, very difficult for me at my age. But then Bombay always makes a difference. It's the best of time I had at Bombay. As a probationer, I was there. I was a DR at Bombay at the time when great Mr. Panchwala was there. And I learned, as a probationer, I learned from accountancy from Mr. Ansutia, you all know him. And law from Mr. Akarkar was our lecturer. As an income tax officer, extraordinarily brilliant. He created an interest in law. Almost every case law, I now see it as a story. Because what people feel, how they are affected, how they react and all that. So that case law has always fascinated me, and I owe it to the Mumbai training. So, and I was surprised to find it appears that more people in Mumbai know me, though I left Mumbai long ago, because people always talk to me about books, my books and all that. That shows that more people know in Mumbai and Gujarat know me than in Chennai, Tamil Nadu and Kerala. That is also a great interest. You also have great opportunity to test your law. All kinds of problems come, always of great magnitude. Stakes are very high, and you tackle it very well. So I've been always following the Mumbai High Court and Mumbai Tribunal benches much more than anywhere else. And the contribution is of the profession. Because ultimately the law develops in the manner in which profession feels that. Whenever I make a comment when a bad decision comes, I say that it was not argued, the profession has made a mistake. Then I get angry letters, where you present, how do you know I have not argued that? But unfortunately, it is argued sometimes and it is not recorded. And I always tell that we always blame ourselves rather than the judges, because we cannot afford to criticize the judges. That's how it goes. Thank you.
Friends, good morning to all of you.
Good morning.
This is the first time I've had the opportunity of participating in a brain stress session. I had never got the opportunity of participating in a brain stress program. Well, I said yes because I said it's the first time I'm doing a brain stress. Let's see what it's all about. And then I think calling me a trustee is a misnomer. So many eminent capital accountants. I think I'm going to be a beneficiary rather than a trustee. And I say not just to flatter you, but I just sincerely because as lawyers, basically by the time the case comes to court, it's already 7-8 years assistant years over. So we are dealing with something in 2003, 2004. In fact, here in Bombay, we're dealing with 1985, 86. That's a different matter in the High Court. I was told that assessment years of 91, 92 are still coming up in court. We have Madras is much better here, up to 2006, 2007. And so, also, as you mentioned, Bombay is a special affinity. I was born in Bombay. I did my schooling in Pune, so there is a special affinity for Bombay which continues. And hereby I mentioned that I got up at 5 o'clock. So that was a deliberate move by me so that in case I make a mistake, I can blame it on my own sleep. Now, I must congratulate the persons who have framed the questions. I must say that quite a few questions are controversial. They could be possible opinions. So I'll give my views, and I'll be very grateful if you can tell me if a contrary view is possible or where a different different view would be there. That will be, I would prefer it to be more interaction than just my saying a particular answer. I think the questions have been, shall I start? Since you all have finished early. The first question is, can I take it if you want to the same?
Yes.
The first answer as far as the slum sale is concerned, in my view is that this will not qualify as slum sale because values are being attributed. You are taking it as book value, the values are being attributed. One question is, it says 2(1)(b) says individual value to individual assets and liabilities. Now what does individual mean? Does it mean you must ascribe value to individual items of land, individual items of machinery? In my view, no. The individual can refer to the category of assets. So if you ascribe a particular value to plant and machinery, that also will be falling foul of 242C and it will not be a slum sale. The second question I'll finish on the argument and start. Anybody got a contrary view, you can. Okay. Fine. I just give my views. If anybody has got a different view, let me know.
On this issue, sir. Yes.
Sir, here the individual values, because it's a book value, people know. Whereas transaction is at a slum sale, which is for a lump sum consideration. It's just that it happens to be a book value, so that people, you know the individual values.
No, that was one doubt which again a colleague had when we were discussing this particular problem. That even it's very coincidental that your slum sale value becomes your book value. And I thought that you have done it only on the basis of book value. Now you say no, you are not looked into the individual, you have taken a round figure and by coincidence it happens to be that. Then in that case it will be a slum sale. The only thing is that question we had a doubt whether 55 will be applicable to that slum sale. Because your book value is presumably much lesser than market value. The 55 we had. That was a doubt. And me and my colleague were having a session in our office.
But sir, this slum sale, business, there is no market value for business.
No, you see the point is as far as slum sale is concerned, typically speaking, if you want to sell a business, you'll be reckoning the assets minus liabilities. You'll be taking into account the market value of the assets, obviously, unless you're not going to just buy the old historic value. You will give me the
So it will be based on the profitability and
True. No, to answer your question, if you are not, if the breakups are not part of your listing, but it is just on the book, then it could be a slum sale. But since I saw the figures, I thought that you have a book value. And very rarely in my experience, slum sale is equal to the book value. And just think about 55A. As far as 2 is concerned, unfortunately, the not an amalgamation, the amalgamation in terms of 391 of the Companies Act is not an amalgamation of 2(1)(b) because post-merger, third clause is not satisfied. The 3/4 shareholders vote continue in the amalgamation.
My question is number 4. It starts with number 4. It's about number 3. Yes. It's a section 72A requires 75% of the book value of the assets compared to the last 4 years. Now, unit-wise, that is not satisfied. But book value-wise, it is satisfied because it was the highest the last 3 years was 4 lakhs. On the day of merger, it's 3 lakhs, so 75% comes there. Probably the question is prompted with reference to the quantity or with reference to the first year, which was only 2 lakhs, whether it is 75% retained or not. You have to see the date of merger, what was the book value. And then you see the last 3 years. I understand it that if in the last 3 years maximum you can see, and if you have 75%, it's all right. And apart from that, what we find here is, he has not done anything, he has only replaced some machinery. That's all. He has not that he has sold it. The whole idea is he cannot acquire just 1 year before and abuse this section 72A. That is very well looked after. Here is only some machinery replaced because of age or not done value because the price at which it is sold also indicates. So there is quite safe for justice to pay 72A benefit. Question number 4 refers to slum sale. Now, in the case of slum sale, the question is Now, in slum sale, there is no identity of the asset. Otherwise, if you identify the cost with any component in the asset, then it is not a slum sale at all. The very quality of a slum sale definition is that you can't identify. Now, the purchaser, he need not follow the same value. He need not follow the turn-down value of the seller. The purchaser need not in a slum sale. He can see the net consideration which he has paid. He can distribute it in any manner which is reasonable. In a particular case where he adopted a value different from the turn-down value, and it was justified by a chartered accountant's valuation. The High Court in Shri Arvind Industries Limited was joint CIT. You don't have to bother to write down because I have given my return replies, which I am sure it will be conveyed to you in due course. That's what Mr. What said. Shri Arvind Industries Limited, joint CIT. They say he is not bound. The law itself gives a clue because whenever you are bound, return down value is bound. The sale and lease back transaction, or the successor has to follow 49 and 47 PDT, or section 43, whichever, wherever actual cost says follow the return down value of the predecessor. They have said so. They have not said it in slum sale because the law gives you freedom to allocate it in a reasonable manner. The net consideration can be distributed. That's my answer.
We now come to question 5. I think with the permission of the chairman, I just read whatever question allotted to me sequentially and then he can close with this. I've finished 5. I think 5 and 6 are for me. And then I finish 5 and 6 and then 7 can. As far as 5 is concerned, it's an interesting question. In my view that A is right, you can't take the treated as income from deep letter whole property, and my reason is this. If you take 23(2) of the Act, then you find that once it is occupied by an owner, then the annual value is deemed to be nil. And once the annual value is taken to be nil, because occupation by the owner will include occupation by a co-owner also. There is no need that all the owners will necessarily occupy. So when it says it's the occupation of the owner in law, in the transfer of property also, owner will include the co-owner. Then the annual value is taken as nil. Once the annual value is taken as nil, merely because the other co-owner residing in another place, it can't be taken as income from being let out of property. That's my view. Then coming to number 6. Yes. As far as number 6 is concerned, well, I have gone on the basis that all are residents. I have gone on the basis that all the XYZ are residents. And see, once the tax is deducted in the beginning by payment to the consultant by X, there is no question of again deducting tax at source, because when they reimburse the expense, it does not partake. The expenditure is not of a character mentioned in those 194 series. Suppose, for example, I pay commission on behalf of everybody, and you reimburse me the commission. What you reimburse me is not a commission payable to me, but the commission has been paid on that tax has been deducted. So there is no question of deducting TDS once again when those people reimburse me. You can also take the advantage of section 69 of the Contract Act, where it says that if I make a payment to somebody else obliged to pay, I can recover that amount. So that amount is recoverable to be a contractual debt and not in the nature of a commission.
This question number 7. It's a problem faced by many taxpayers when they are availing the benefit of section 54 or 54F. The purchase is already in your hands. Construction, it is in the hands of the contractor or the developer. It so happens that construction is not completed within 3 years. No fault of yours. So the question is whether in such cases the time can be extended beyond 3 years. The law does not provide for it. No assessing officer will dare to say, poor fellow, it's not in his hands, I will give you the relief. But then there is one tribunal decision which the questioner obviously had in mind. V. A. Tarabai was Deputy CIT, 1480 trip 15 Chennai. There it was held that when you are helpless, law cannot expect you to do the impossible thing, therefore you should get it. But there is also some case law in compulsory acquisition cases where it is delayed, compensation is delayed. Like Gopal Reddy and Rhoda Mistri's case, yeah, API court said. If you look to 54F, law itself recognized it. Now that section 45 has come, the necessity of finding out whether whose fault it is does not arise. I have my own doubt whether in spite of all this, whether it can be, you can succeed with guessing officer or even in first appeal. It's all right for high courts to say, interpret the law in an equitable basis. Shri Arvind Datar in case has pointed out, it's a rare case where high court has followed equity principle rather than equity only high court can do, and even high court when it does, one is always surprised because they have to go, we have to see the first principle golden rule is to interpret the law as it is. Purposive interpretation is rarely done. But there are, I can give a clue that in the case of development scheme, for Delhi development scheme, they said that it's no fault of yours, so if you have given the money, it's all right, you will get it. Then there was a representation, why Delhi alone? Why not development scheme anywhere else? There's a circular also saying that the development scheme, if it's the fault of the developer, you can get it. You can use that. Circular number 667 dated 18th October 1993. There they said that if it is under scheme and it failed, there's a failure, it doesn't matter at all. But with all this, I would say the best remedy is you move the board and 119 to be genuine hardship. You are helpless. Because even this question of whether you are really prevented from by your own, it's not your fault. It's not easy to prove. Because after all, before 3 years, you may be aware that the developer will not be able to complete it. And in that case, you do not switch over your investment somewhere else. It's a question that may well be asked. Because the money is in capital gains account scheme. So I would say this is a 119(2)(b), normally we don't use it. For the main reason that the board will not agree, they will always only a negative reply. But my theory is, you apply, get a negative reply, you also try your normal means. But at the same time, you can go to the High Court and writ. There are a number of cases where the board has not exercised its right, its duty to represent, see your merit, consider your application on merits, you have a chance of success. Because these are hard cases. Because you will have to, it will become taxable the year in which the default occurred. And I can't expect any assessing officer to see whether to allow it when the law is very clear. 3 years, you have not been able to do it. You have to pay tax. That's what anybody will say.
Next is Councillor. Okay, sir. But this is a slightly unusual question because you say that the compensation was awarded in terms of land. Now, I'm not a land acquisition lawyer, but I spoke to a couple of people. Normally, land acquisition money purely by way of monetary compensation. They normally don't allot you land. But let's take the example as it is. Now, I presume that the acquisition took place in year 1, but the land was given in year 2. To answer the question straight away, I have no doubt that 45(5) applies. 45(1) is no application. 45(5) alone will apply. A, because it specifically deals with compulsory acquisition. It also has a non-obstante clause. So it also has a non-obstante clause. So when you have a special class category of acquisition cases, they all will come to 45(5). Only one difficulty I got is that there is a Kerala and Allahabad High Court saying compensation can be in kind, compensation in cash. But this is a practical difficulty. So my land is acquired and I get, say, land will say 5 crores and the capital gain tax payable is 2 crores. Now when I get the land, I may not have the money to pay the 2 crores, you see. And again, if I sell the land, what happens? Do I again pay capital gain of the tax and sell the land to pay the earlier tax? So the answer is A, 45(5) applies And I wanted to check also whether there are cases where the government has given land in lieu of, because if you take 1894 Land Acquisition Act, it only talks of the collector. The first is a land acquisition notice under section 5, and there is objections, and then the compensation awarded, and it's subject to enhancement by the district court. So all those are cases of monetary compensation. I was wanting to know if anybody got a peculiar case where the Maharashtra amendment is giving land in
TDRs are given in place of the
TDRs.
transfer of development rights. This is
In some cases where displacement is there.
And they give you land in lieu of it.
yes.
So in this case, can we argue in terms of displacement or this kind of reinstatement that there is no transfer at all? It is just a, putting the same person into some other substitute.
But see, if it is an exchange is equal to the definition of transfer.
Private is okay. It's like, it's not something like a voluntary action.
No, but by definition, compulsory acquisition is not voluntary. It says the power eminent domain, the state can take a property for public purposes.
In section 1037, there is specific exemption given to this kind of transaction, but that is restricted to only individuals and accidents.
Sir, what about the applicability of 43CA and the 56 for this?
Yeah, so as far as 43CA is concerned, the whole thing will come under business and land being held as a stock and trade and so on and so forth. I just did the classic case of, on the assumption that it is a asset in terms of 43.
If the holder presumes to be a stock in trade.
In fact, I made a note here 43CA, but I didn't want to complicate the question. I said I will stick to 45CA because 43CA was its own application.
56.
Pardon me?
50.
50C level, yes.
No, 56. 56.
No, the 56 to that question is coming later. 56 to 70 question is coming later. I'll deal with that.
So, it seems that here in case of individuals and accidents, there is a parallel provision under section 1037. Which is a
Subsection?
37.
That is applicable to individual and individual.
But that exemption is applicable to individuals and accidents. That section is only for individuals and accidents.
Okay.
Other facts and circumstances being the same. Now here is the case of the company, right? So prima facie it looks like 1037 is not applicable. Now my issue is whether I can claim that this is not a transfer itself. I am just reinstated. It is a substitute given to me. The intention, as we say, there is a case of displacement. I mean, people are getting other place and government is acquiring for some construction purpose or other. My intention, though it's a prima facie, is a transfer. I mean, what you call exchange or transfer, whatever it may be. But here the question is probably because, as you said rightly, if the citizens or the taxpayer is not having any liquidity, from where he is going to pay the tax? You can just replace other assets as a government. So, can you argue that there is no transfer, there is no intended transfer?
No, I don't think we can say there is no transfer. In law, there is a, I mean, your acquisition taken away, you got a new piece of land. They will say it's an exchange, you go land, you will pay.
Sir, exchange.
If you will say it's not a transfer.
But this exchange is not voluntary, so it's a compulsory acquisition.
It's
That's normal
basically intended to replace.
Both are agreeing to.
No, see, for one, there are old sales tax cases where the consideration is not voluntary, it's about for sale of controlled commodities, there is no transfer, that was subsequently overruled by amendment. Partly you're right, because there is no free volition, it can't be a transfer. So we must see the fact. So for example, there is a particular scheme where, say, none of us have your land or displaced, you have land elsewhere. Then you can say that my land has been taken away, I got land, the amount in exchange. You can certainly argue there is no transfer, and even the expanded definition of 247 will not apply in such cases because there is no transfer, it's been land taken away. You can argue that case.
We go to question number 9. Business expenditure, employees' contribution to provident fund. Employees' contribution to provident fund has to be allowed only in the year in which employee's account is credited according to section 36.15a. So the officer says that I will not allow it. Though it is paid before the due date for filing return. That's the question, whether his officer is right. Now, my first argument will be in 224.10, which refers to the welfare dues. What is broadly categorized welfare dues? PF, ESI, and gratuity contributions. They are all covered one. It doesn't make a distinction in gratuity contribution between what is employers and employees. Apart from that, there is a direct decision for the Madras High Court in Madras Radiators and Pressings Limited, where they have clearly said there is no distinction between employers and employees' contribution is concerned for the purposes of section 43B. That was not cited in the case where there has been adverse decisions. Then another case of Uttarakhand, CIT versus Kicha Sugar Company Limited, where the only issue was employees' contribution. That was also in favor of the taxpayer. Better than all this is ILM Extrusions Limited's case itself, which followed Allied Motors and said the benefit of extended time should be available for all persons wherever this payment is made before the due date for filing a return. ILM's case itself, there is a reference to 3615A. It is surprisingly, they are saying how it came about, this extension of time limit came about. There was, they said it's great hardship. And then the department reacted to it and came out with this. And they are also saying a very telling point. If you don't allow it in the year because it's delayed, and you can't allow it in the year in which filing of return is there, by that time also, it will never be allowed, they have said. It's surprising to me how that issue should come when ILM's case itself answers. Now, there are decisions distributing ILM's case in respect of employees' contribution itself, and that is very point, one of the points that is discussed. That shows most of us make the mistake of going by head notes rather than the text of the decision. And head notes are sometimes even misleading. I have seen a number of cases where, though head notes, if you take care to see the head notes represent the correct view, sometimes it's partial, sometimes it is even patently wrong. This according to me, is an illustration of how we are sometimes going on law without bothering. Two mistakes we make. We ignore the statute law. First thing is, see the book which Mr. Datar has got completely tattered, because every time he sees the statute first. Then I always say, my auditor, for instance, the book is, act looks very untouched. That means it, he may be very much concerned with law, but he should also see the statute first. Second is, whenever you cite the case, see the full text. Sometimes it will help the other party when you are laying a decision, when you go by the decision itself. So this is a case which illustrates the need for going to the decision fully. Thank you.
So if the payments are made, within the outside the
Yes.
within the grace period, then what
Grace period. No, grace period. See, I think, if you pay during grace period, it's as good as having paid in time. Now the question is, you can pay up to the date of due date for filing a return. So that it is immaterial whether you are paying within the due date or within grace period. Now if you pay during grace period, there is no problem at all. The problem is you have not paid during the due date, you have not paid during the grace period, you are paying before the due date for filing a return. That is enough after the amendment. And as interpreted in allied case and also this Allen's case.
But in that Mumbai tribunal judgment which is against her, they also commented about the grace period. But they said because that is not the issue, we are not deciding on that. But they have observed even if it is paid in the grace period, it would have not been allowed. But they have not decided on that. But observations are there. But as you rightly said, grace period should be allowed.
But anyway, the point is, employers and the employers' contribution, there is no difference.
Yes, sir.
That's all. This
Yes.
question relates to that.
Yeah.
Confining that, it's all right, but I have said something more also. Because I feel very strongly, because it's not that only disallowance of under 43B. 40A1A, 40A1, 40A1A, that is most damaging.
Yeah.
So we have to be extremely, this point we have to not to heal the top very, very strongly, I would say, in that way.
See, we have limited time. Everyone has to catch the flight, also even sir has to leave. Let us not make it interactive. Let us proceed, otherwise we will not be able to finish the important questions. And we will, if time permits, at the end, we will get the interactive session. So let us continue with their replies first. And you have the points, we can take up at the end of the 30th question.
Yeah, I'm sorry because of the constraints of time, and we are here to learn, so post also anything you can always tell me any particular point you got to think. Now, just 1 minute just to digress. So Rajaratnam mentioned that it's important to read the section. I will tell you, when I wrote the book Courtroom Genius, you wrote a book on all the important cases done by Palkhiwala, and I had the opportunity of interviewing a number of people who worked with him. One common feature which many people told me, including Soli Swarabji, Dadi engineer, others, was that he would always read the section again and again rather than go to the case law. And then this I found, there was a leading barrister in Madras called B.L. Etraj, leading criminal lawyer, and he donated his entire fortune to start the Etraj College. So he used to always say to his juniors, every time he did a murder appeal, he would read 302 IPC once again. So that was the important. And one other thing I'll share as a practitioner, which my seniors have told me, when I briefed Mr. Parasaran's father, he was 93. He's perhaps the greatest lawyer I've briefed. And he told me that when you work for a case, 60% reading, 40% thinking. So that's what he said. He said, you think 40% time, just think, reflect upon it, close the book and do it. And he told me, which I rarely did it, he said, 48 hours before your case comes, you should close the brief and open it in the court. He said, if you endlessly prepare, you'll be endlessly unprepared. So, sorry for digressing, but I thought I would share it with you. So now, in fact, just to tell you, when I first briefed him, at law college we had not done Roman law. I had briefed him for a very important contempt matter against Ramnath Goenka and others. So when I came, he was 93, I was just 5 years in the bar. And from law college I used to go to court and sit and watch the proceeding, because Madras college students strike very often. So I used to go to the court and listen to him. And my dream was to brief him in a matter. So when I first sat with him, he said, how old are you? I said, I'm 5 years in the bar. How old are you in the bar? I said, I'm 5 years old. Then he said, he said, do you know that there is no contempt in Roman law? So I said, sir, we did not have Roman law in our law college. He looked at me, you're unfit to be a lawyer. Anyway, let's get on with this. Now coming to this topic, on 143.2 notice, well, with great respect, the Punjab Haryana High Court judgment is seriously erroneous. I tell you the point because the court makes a fundamental mix-up between issue of summons and service of summons. If you take the Income Tax Act, they have used service in sections. For example, 132, 132A, they have said issue. In some other places, they have said serve. Now, just to tell you, take Order 5 of this Code of Civil Procedure. Order 5 of the Code of Civil Procedure. The title is Issue and Service of Notices and Summonses. Issue and service of notices and summonses. Order 5. Order 5. And Order 5, Rule 1 to 8. Order 5, Rule 1 to 8 talks of issue of summonses. And Order 5, Rules 9 to 30 deal with service of summons. So the law makes a difference. Similarly, I couldn't get time, but in the line I was thinking of non-bailable warrant. The magistrate issues a warrant. Service is different, issuing is the same. But Punjab says both can be interchanged, which with great respect is not correct. The other point is, you may just note down these judgments. 300 ITR, 243. 306 ITR, 309. 307 ITR, 53. This is Punjab 100. And very important, 110 ITR, 110 ITR 36, it's a full bench of the same Punjab Haryana High Court, which has distinguished Banarsi Devi. You see, the Punjab judgment, which is creating problems for all of you, has referred to Banarsi Devi. But Banarsi Devi has been distinguished by a full bench of the Punjab and Haryana High Court. All these judgments I cited. One more I forgot. 34 DTR. D for Delhi. DTR 119. Again Punjab Haryana. The first two judgments I give you are Delhi High Court 300 and 306. The remaining all Punjab Haryana High Court judgments, which make it very clear that issue and service are quite different.
Before I start the earlier one, The one point I left out in answering the question.
He wants to clarify the earlier question, please.
That is, the questioner has asked, therefore Vidyarthi Nigam case says that it is in favor of the revenue, that is employees' contribution should be different. And there is so much law, one need not be obsessed, unnecessarily worried about a straight decision. It's clearly a decision rendered per inquiry because none of the other decisions have been cited. So our obsession with law sometimes makes us unnecessarily nervous about an odd decision which is against us, which is nowadays becoming more common. They are no longer rare.
Now, question number 11 is quite interesting. It's a bit complex. And as somebody mentioned about 5627B. Now, if you read that particular section, 5627B, at the time of booking it was 300. At the time booking the flat 2000, and the stamp duty came at 3,100. And today, I presume that today is the day when the sale agreement is to be registered. So I presume that will be the same date as you talk.
Yes, sir.
Well, if you take 5627B, my view is, and we had quite a lot of debate in my office on this particular issue. It talks of receiving property, you take 27B, where individual receives in any previous year immovable property without consideration. Receiving property is perhaps when the possession is given to you when you take the property with you. But as far as for the purpose of the 5627B to make thing, in my view, the date of allotment will be important because that's the time when the right accrues and the agreement takes place. That's the time when it has to be done and not when subsequently when the sale is registered. That is my view. And the stamp duty also will be taken only on the date of the allotment letter. That's the value you have to take and not on the current date. Then the third question is that the allotment letter issued in 2010, fixing the amount of consideration can be said to be an agreement? Yes. Yes. Offer acceptance is complete, contract is complete when the allotment letter is issued. The sale deed is taken at a later point of time. Okay. The next question is Mr. Arvind.
Next question, question number 12. That is development agreement. Accommodation is provided by to the client owner that till such time as he completes, he will give it some flat for occupation. Now rent has to be paid. Now the immediate person tenant is the client of the developer. He makes the payment. TDS, what happens? Now the answer is very easy according to me. Section 199 requires that the person who claims a deduction, TDS certificate should be in his name. So what is important is TDS certificate should be in developer's name. Now if tenant pays and then get the rent reimbursed to him, all that he has to do is TDS certificate which is done, PAN number should be that of the developer. If you ensure that, it makes very little difference who deducts tax or who issues the certificate. Now everything is mechanical, so AS28 or whatever it is. There you give the PAN number of the developer and whoever pays the money into the account of the government, it matters very little. So I would say that we did not go into the law so much. The practical aspect is my solution.
Yeah. 13. 13 also, if you see again, an interesting question. NRI has got 2 flats, so 54 acres out. Oh, sorry, sir.
Sir, well, there are many issues.
There are many issues.
A is answered, sir. B, C.
I asked the PLC, right? I will come to that. So the second question is, now 194 1A, whether whether that 50 lakhs limit should be with reference to the seller or the purchaser. My answer is different. I am on a weak ground because Mr. Kapasi told you that it is only from the seller's angle you have to see. Sellers are co-owners, so each share falls below 50 lakhs. But that is so for the purposes of assessment. It is the seller, each seller is separately assessed, limit is less than 50 lakhs. But the purchaser pays more than 50 lakhs for the same property. So I think that it will be very difficult for the assessing officer to say there is no tedious default on the part of the purchaser. But anyway, when Mr. Kapasi says, I can't say he is wrong, but it's a matter of doubt when two people differ. As Kapasi, the quotations he gives, if you have got one watch, you can give time. If you have got two watches, you don't know what time to give. So this would be such an instance. I would say always feel safe. We have got our own problems. Why do you want to take the problem of the other party? TDS certificate you deduct. And after all, he has got a remedy. He can get a certificate under section 197. Of course, it's only a remedy in law, not in practice. Now, they were delaying also. Now there is a recent circular in January that within a month they must dispose of. Then what is the use if they dispose of negatively? So we have got all kinds of problems. It's a vicarious liability which we should not undertake. When in doubt, deduct. That is my solution.
Sir, we have...
Yes, 3 questions in one. Yes, PAN number. Now, PAN number is not given. 206A says you must pay 20%. You must deduct. Now, what is the answer? The section is very clear. If it does not give PAN number, you have to deduct. Now, in the case of non-residents, my advice is normally for the person who pays to apply for and get PAN for the payee. Now, people say that if you say that you can apply only by using section 163. Now, section 163, they will say, because of that, they will say it's a permanent establishment and right to tax so many other things. I don't think that fear is not justified because 163 applies whoever makes a payment. He can claim he's an agent. It becomes automatically an agent under the law, though the officer has to give a notice. So he can do that. He can save for the non-resident. Now, for example, the technical fees are royalty, only 10% deduction. If you deduct 20%, and if the agreement is that the Indian payer has to bear the amount, ultimately who suffers is only an Indian payer. So he must try to get PAN number. As far as the local person is concerned, I have no sympathy. If the payer does not want to get PAN number, let him face 20%. After all, he gets credit. We are not doing 20% to deduct, he can always get a deduction. We need not have too much sympathy for the deductee if you are a deductor.
D.
No, D again. D, 4 questions in one. So, joint ownership, payment to each. Joint ownership, payment to each transfer, and that we are already answered.
Chetan bata.
As per section 194, 1A, tax deducted at the time of payment or credit to the transferor. Who can it be said that the amount is credited to the account of transferor, particularly when no books of accounts are maintained? See, section 194, 1A says at the time of transfer or at the time of credit. Now, if credit is earlier to the time of transfer, time of registration, even then you have to deduct tax. That's what section says. Now, no accounts are kept, which means other thing will apply. No accounts are kept, there is no credit in the accounts. But transfer, other thing is always there. The answer is simple. It's a very clever thing that you can postpone till the date of actual transfer. You don't credit it. That is all. Because they have said they must set the date of agreement or when it becomes due. They have not said it. They have said when you credit in the books only, no books, no credit, no deduction. Then I suppose that's the end of it. He is also there, very good. So, yes, the F also is there. Very unfair. He makes a payment that should be for royalty. And we shift to USA. It's a very, very, very interesting question. At the time of payment, he was a resident. Then he becomes a non-resident because he is shifted. What happens? I thought he's a resident, I don't have to deduct tax at the relevant time probably. Now he has become a non-resident. Can I be punished? That's what he says. As far as the asking officer is concerned, he will say you have paid to a non-resident, therefore you are guilty. Now there is a decision of the tribunal that if the assessing deductor bona fide believed that it is not deductible, then he is spared. I am not very confident of the correctness of the tribunal decision. There is a fault. You cannot be penalized. Certainly you can't be prosecuted because at the time of payment you did not know. So it's also a case of genuine hardship. But I would say the answer lies in the amendment to section 201. You get the particulars that the other party has paid the tax on it. After all, he has to pay tax. He was a resident, he has become a non-resident. The property that he sold is an Indian property, so he is liable for tax. So get the information from him. Then the department may say that 201 amendment has come only now, where you have done it earlier. At that time you would say, I would say Hindustan Coca-Cola's case has been recognized in 201 amendment. Hindustan Coca-Cola said that if the deductors paid the tax, there is no responsibility for the deductor, except for the delay in payment, interest, because he might have paid later and deduction due date might have come earlier. So that's a trump card. I would take the trouble of saying, instead of saying, oh, I am helpless. But the officer is also helpless because he has to see his payment is a non-resident. At the end of the year only you can find out. So here again, we have to try to solve it practically.
The last.
Yeah.
Yes.
This usual case of a car loan. Now, registration certificate is not a document of title. And now it's a EMI payment, whether it should deduct. Interest element in the EMI payment is certainly liable for tax deduction. And if the firm is the person who ultimately bears the amount, though it is in the name of the director or a partner, it makes no difference, is firm only. As I earlier said, 199 is the key. Now, who is getting deduction, claiming deduction? Is a firm or a company, as the case may be. So, in such a case, a TAN number should be of the company. Though individual may be, his name may be there, care must be taken for that because ultimately tax credit should go to the company because it is the financial institution. And I mean company, I mean the bank, bank there is no problem. Any financial institution which receives it should get the deduction. So my answer here again is only person entitled to it is certificate is financial institution to which it matters little as to who deducts tax. Whether it's individual who deducted tax or the firm or company which deducted tax. See the TAN number is a proper name. My answer to all the 5 questions together is, in all the queries, I wonder why the person who is required to deduct tax should try to avoid tax deduction for the benefit of the deductee at his own risk. Because people, why should we be worried? The poor fellow is paying more, I am getting more deduction. So the person who should worry is the person I will be disallowed. I will have to pay interest. I will have to reimburse the tax. I will have to pay interest. What is worse is 41A.
Question number 13. Actually, the A and B are the two things, and 1 and 2 applies to both A and B. Kindly see the question. Initially I thought that 1 and 2 applies to A, but then you read B, 1 and 2 is in the context of B also. In simple terms, this gentleman who has flats at Pune and Thane, he is going to sell his flat in Thane, and he has two options. Either he takes the sale proceeds and invests in capital gain bond for 3 years. That's option number A. That I thought will be subject to one point that way whether the amount is more than 50 lakhs, because he wants to invest in 54 EC bonds. The limit is 50 lakhs. So if it is less than 50, he can put it there. Beyond 50, you have to consider whether it's worth putting into the 54 EC bond. Secondly, after assuming it's less than 50 lakhs, he goes for these bonds. Then subsequently, he takes the same to the USA to invest in a flat or house in USA. I think once he has finished the 3-year period, it's up to him to do what he wants. I don't think there is anything further restriction as to what he does with his money. I have not got into what is the amount which can be repatriated and so on. And this use the sale proceeds for higher education in US children. I did not understand what is the purpose of this particular question, because I could not see any reason by educating in US is going to get some any tax benefit, because once the 3-year period is over, he can do what he likes with it. The second thing is more important. Suppose he sells the flat, and now immediately he wants to invest in a flat in a house in USA. As far as here is concerned, 54F is out because he has got 2 houses. Take 54, he gets the benefit. As far as house in USA is concerned, as you know, there are 2 conflicting tribunal decisions, where Mumbai and Bangalore are in favor of the SSC and Gujarat is against the SSC. So it depends on his appetite for risk, if he wants to take the risk. And I still feel that the view of Mumbai and Bangalore are correct, because it simply says invest in a house. It does not say invest in a house in India. The only difficulty is they will retract. Ultimately, in next budget, they may say, how shall we deem to be a house in India from 1962? That is the only. But as of now, it stands, the interpretation given by the Mumbai and Bangalore tribunal appears to be correct. Now, after selling the flat and using the sale proceeds for higher education, frankly, I do not know what is the impact of using it for higher education, what reduction is available, or so I don't know who has asked this question. You can tell me after these sessions is over. Yes. And one more thing, suppose as far as this is concerned, as per the DTA, there is no exemption from not deducting tax at source. You have to necessarily deduct tax at source. The person who's paying, he has necessarily deduct tax at source. Then come to 14. 14 is simple. I think they know you have all okay to solve complicated questions. So 14 is again simple. As far as buying in the name of the SSC son, you will not get the benefit. The 250 on ITR 174 is very clear. And buying in the name of the person and his spouse, that is the Jennifer Bailey case, is 314 on ITR 1080.
Question number 15 is also on TDS. The 234E, if the director does not file the return in time about the deductions which he had made, now he has to pay 100 rupees per day, because it's much better than 10,000 rupees which was there earlier. Which was a penalty, but you can escape because of reasonable cost. Now they made it 100 and they call it fees, so that you cannot escape. The reasonable cost clause will not apply. They have not given a show cause notice, is not there. So the principles of natural justice is there. But then they also be careful to limit the fees to the amount of tax deducted. If it is not there, I would ask Mr. Arvind Datar to take up the question of constitutionality. Which has taken successfully at my instance in one case and got stay from the High Court. The challenge to the amendment, this 215 amendment, charity, one of the worst things that the law has done. And there I had persuaded 2 of my persons who came to me for consultation to challenge the constitutionality. It was admitted, and 2.5 years have passed now, no counter filed by the department. So constitutionality, even at least reading down, it's very difficult for the court to say an amendment is wrong because of the freedom which Parliament has got. But then you can read it down to accord with what is patent injustice, 1% reduction. for contractors. Disallowance 30%, tax on disallowance is 30%. Is there any logic in? But somehow Madras High Court has said it's not required to read it down even. But anyway, here 234E, now what happens is, what happens if you should delay? Nothing happens for the department. Because the question of tax credit comes only when the payee claims credit for it. Now it is nearly a year difference. But if you wait for 1 day difference, that 100 rupees you have to pay. No logic at all. But I do not know. It's not easy to challenge. I don't know, Mr. Datar, I would like to say whether he can challenge it.
Now, coming to question number 16. In fact, I just tell you, with regard to question number 14, those of you interested, we have dealt with this point about investing in the son's name at page 1246 of the Kanga Palkewala, footnote 16, volume 1. And with regard to buying joint name of spouse and necessities, page 1272, footnote 9. Now coming to question number 16, 44AB will not be attracted. It is directly covered by a circular. It is directly covered, question number 16 now. It is directly covered by circular 452 of 17386. And if you want the text of the circular, it is in 158 ITR Statutes 195. 158 ITR Statutes 195. For those of you, because we are supposed to keep the 2 volumes, we have, as you know, we have put all the circulars, etc. in DVD, which is along with the book. So all the circulars are in DVD. And this particular point about 44AB and commission is dealt with at page 1145 of Kanga Palkewala, footnote 34.
Question number 17 is again on TDS. It shows that the department is so much obsessed with TDS. We are also most of the time dealing with problems of TDS. It's very safe for us because our own assessment you can do whatever you like. But deduction, you be very careful, then you are safe. So here what happens, question number 1, that reimbursement. Now a person sells some goods. Then while in the transmission, he incurs a lot of expenses like warfare charges, stevedoring charges, ground rent and all that. Now should it be de-linked with the sale price? If it is part of the sale price, no need for deduction. Because you are reimbursing for some particular items, the assessing officer will say you have to deduct. Now the question is whether he should deduct. My answer is that we have to see the terms of the agreement. If it's an ex-factory sale, then whatever expenses are there, deduction must be made. Now whether he makes the payment or you make the payment because you are ultimately reimbursing it will be the question. There again I will be practical issue, section 199 only. The person who claims it is the purchaser who makes the payment, who reimburses it. So he must, his 199 tax deduction certificate should be in his name. The other person may pay or you may pay, it doesn't matter at all, as long as the TDS certificate is there. But who should bear it, whether it's to be borne at all, tax deduction at all is necessary. If it is ex-factory, that other fellow has to pay. Now if it is total, you have agreed to purchase for it, in all, it's only a component of the price. In that case, I don't have to deduct at all. It's only the seller who has to deduct. I hope that it's non-controversial. That is, now the next question is, if a company receives a gift, now 5627A, any firm or a company which receives gift of shares is liable for tax. Now, according to the question, the persons, all the shareholders of the company, of the donor company, are relatives of the shareholders of donee company. Will that avoid because of the relationship? But we are not talking about 5627 for finding out relations. We are on 5627A. How can you avoid the tax? But what intrigues me is that why should a company give a gift to another company? Is it possible at all for a company to give unless memorandum and articles permit you to give. Should not there be any reason? After all, political funds when they are giving, there is a controversy. Now there is an amendment to the company law saying that political contributions can be made. So I don't think a company can give a gift at all. Now in this case, what I would do is, I will assess the Dhoni company under 5627A, and I will not allow it as a deduction. So there will be ultimately double taxation, but at the invitation of the assessee himself. The question itself is not tenable, I would say. The transaction itself is not tenable. But assessing officer will happily assess at 5627A. You may later on say, I have made a mistake, I could not have given a gift. But you have given a gift, the party has received it. Now you may give it back, what happens? Will it be allowed? Will it be cancelled? It should be lawfully cancelled probably. I do not know. Then third question, notice pay for compensation. So here again, you are understanding that the notice pay amount received by the employer is an income. And then for the employee, he cannot get a reduction. For me, it is only a return of salary. I would not say treat it as an item of income. I will reduce the salary payment because I have got something back. So salary disbursement is less. As far as the employee is concerned, the money which he has paid goes to reduce his salary. It is not a question of reduction or addition at all. If you view it that way and if you write your accounts in that manner, there should be no problem at all. That should be, now it is, if you show it as a separate income, then again it makes no difference for the employer. It is his income. As far as the employee is concerned, he should fend for himself by returning a lesser income to the extent of amount he paid. If he makes a claim, the assessing officer will say, where is the provision and which I can allow? But there is no need for a provision because your salary gets reduced by the amount which you have notice paid. That would be my answer.
With the permission of Vijay.
No, have I answered? Yes.
No, with the permission of
Yes, there is,
around TDS, there is an important controversy coming in the Delhi High Court. It should have come now, but the Chief Justice of Delhi High Court is all getting slow in the Supreme Court, so the case is not adjourned. A very interesting case on SIM cards, TDS. See what happens, suppose there is a SIM card which costs 200 rupees MRP. What the company does is it gives it to the wholesale dealer at 180, and he can sell it down the line up to 200 rupees, the sub-distributor, etc. But as far as, let's say, Tata is concerned, Tata Tele Services, they get 180 rupees. And what that person ultimately says cannot be more than 200 because MRP is 200. Now the department says that the 20 rupees amounts to a commission, and therefore TDS must be deducted in terms of 194H. And now a lot of discussion is going on whether what is the commission, what is the discount and so on. I have taken the view, which I would like to share with you. I have taken the view that if you take 194H, it says that you must deduct tax at source at the time of payment or the time of making credit to his account. Now, when I sell the SIM card at 180, in my books, so the cash account data 180 to say, simple to say. I never pay him 20, I never credit his account with 20. It doesn't really matter whether he's an agent, he's a commission agent, what is the discount, what is it. So this is the accounting issue that is coming up. You read additions on. So I thought I'll share with you because it has huge impact for all the things. Now what happens is the horror is not in the TDS. The main torture is in 40. So that really is a killer for everybody. And now the department has because they are taking everything is sought to be disallowed by saying, especially payments to non-residents. It should not deduct the tax at source, therefore the will be a few lakhs, but the disallowance will be in crores. But I thought I'll share this SIM card issue with you, which is what is whether when you sell a quantity and that man sells at a higher MRP, will that difference be? Because it has implication for everybody. Pharma sector also, I may sell the medicine to you at 26 rupees. Ultimately, he may sell it at 35 rupees. With that 9 rupees amount of commission, should I deduct tax at source on his commission? Now coming back to my question number 18. Well, as of today, the cases against us, the Calcutta High Court judgment saying that the income on an unsold flat will be taken as house property. Those who want towards 352 ITR paid 82. Azimganj Estate Private Limited, 352 ITR. And it's in page 644 to 646 of the Kaga Patwala book. But my view is that the Calcutta judgment may not be correct. If my business is to buy and sell flats, the unsold flat is part of my stock in trade. Even if I sell it after 2 years, it will still amount to business income. So if the sale of that flat is going to be business income, how renting of that flat will amount to house property? But today the Calcutta judgment is against us. Yes, 19, sorry. Now, yes, this is again interesting explanation to 37. My view is fees paid to the lawyer for conducting, legal expenses will not be disallowed in terms of section 37. My view is that what is disallowed under section 37 is only the fine or penalty which is actually levied. Because as long as the trial is conducted, there is no question of to take explanation to 37. Any expenditure incurred for any purpose which is an offence or which is prohibited by law. Now, defending yourself is not a purpose which is not an offence or prohibited by law. You have to defend yourself. And secondly, you have a well-known principle that every person is innocent until proven guilty. And of course, one can say that in some cases they presume the company officer to be guilty and you have to defend yourself. But what explanations apply in my view is only the actual fine or penalty and not the legal expenses that are incurred to prosecute the case or to defend the case.
This interesting question which Mr. Datar answered. Anything connected with crime, and according to them, crime is also extended to so many civil offences, and also it's being abused to a very large extent. Even a payment of trade to a competitor's not commission, it's not commission because you are paying to somebody else for procuring orders. Now they say it's against the law. What is the law? There is no law at all which says that you should not get procure orders by persuading somebody else not to bid it, or employee of some other person not to bid. To that extent they have gone. But even where there is a criminal offence, these days old Supreme Court decision said it must be allowed. Now in government servants conduct rules, if as far as the public servant, if the case is lodged against me, some criminal conduct, say it so happened in one case, Rashmikant Vora versus B.K. Gupta, where the anti-dating was the allegation done. Of course, the case ultimately said that no conviction possible because permission from the government was not taken. So if such a situation comes, now, what do we do? The government solution is, if you are ultimately acquitted, government will pay your fare. If you are not acquitted, then all the expenses also apart from punishment you have to share. So that logic should not be applied. A person is wrongly accused for criminal offence. Now is it fair to say that because he was accused, that the expenditure should not be allowed? That's only I would leave Mr. Datar to react and argue also in the case. It should not be. Similarly, all criminal offences are always personally should be done. So companies are also invariably linked. If some employee has done some criminal act, now if you defend an employee, it should be allowed. It should not be an explanation to section 37, should not come. I am saying this, Mr. Arvind Datar's field. This is a point I feel very much wrongly, explanation is abused, wrongly applied. Certain person cannot do business at all if this is the logic of the department. That everything you have to do, you should not do, you should do business ethically. And ethics as defined by you. That seems to be the logic behind the explanation. Now I have come to my answer, 44 AD. Yes.
But for those who are interested on this, defending yourself, two judgments you can note down. 91 ITR 544, Supreme Court, and Swadeshi Court Mills 100 ITR 59, Allahabad full bench. And if you take
100 idea?
100 ITR 59, Allahabad full bench. 91 ITR 544, Supreme Court judge. 91 ITR 544, and 960 or 962 we have dealt with specifically these questions. Expenditure incurred for criminal and quasi-criminal proceedings. Both we have.
See, you will tax gambling income, you will tax prostitution income, you will tax any illegal income, as also court says. But illegal expenditure will not be allowed. But surprisingly, if you are doing illegal business, illegal expenditure will be allowed. Bhaskara has written in this aspect.
Shakur's case is there. In fact, as he mentioned, there is a case I have also commented upon it. It is, I said, it's very difficult to reconcile all these things. If you are carrying on business in heroin, illegal drugs, then seizure of drugs is allowed as an expenditure. But if you are doing an honest business of pharma, any expenditure, if there is something seized, then that will not be allowed. So either you be fully illegal or you be fully legal. Don't be halfway.
Fully government.
Section 44 AD, that is a boon for small taxpayers up to 1 crore turnover. You need not pay tax. Only exceptions are professionals are not. I cannot use it. Very bad thing. Most of the professionals would like to go under this if only it is available. We cannot do it. Now this the question is, and now 44 AD, what does it say? It leaves out professionals. It also leaves out commission and brokerage business. It leaves out this transport hire, but that is because there is another provision for it. Other than that, everybody is covered. Here is a person with a labor contract. Certainly 44 AD is available, 1 crore. If it is less than, turnover is less than 1 crore, he has to pay tax on presumptive income. Now the question asked is whether he has to file keep accounts under 44 AA, so that the penalty under section 271A, whether it will be attracted. That's the question. Now there is a section itself says, 44A itself says, it will not apply where 44AD will apply. So there is no section, yes, in 44A says or 44AD says. 44AD says rule of application. So because of the cross reference, very clear that no accounts need be kept. But if he wants to have an income determined less than the presumptive income, he can keep accounts, have this audit 44A will apply. And then 44AB also will apply. 44AB is mandatory if you want to have proof, be assessed on income less than the presumptive income. That itself shows that 44AB does not apply per person below 1 crore. That is also, that it makes no sense at all. If you are being assessed on presumptive income, it should make no sense in asking for a 44AB report. So the answer is that 271A, 271B will not apply. So 1 crore less, it's a safety for all the small taxpayers. Next question is very interesting. One of the very bad features of our taxation is 48.3. But it's based upon the principle that all check transactions are genuine, all cash transactions are bogus. It's a superstition which the department has got. So that now we have got an easy method, cash for check we exchange. Is it not? That's what happens. Nothing is achieved by 48.3, but 48.3 is there. If it's genuine, the courts have got the extent of saying genuine transactions also are affected. Genuine transactions in cash are affected, will be disallowed. Which shows that it makes absolute nonsense of income tax law itself. You are not assessing a person an income. But it's not for us to question why. It is for us to do and die. As Denison said in some, that on brigade war, when it went into war, that is what the people have, soldiers have to think. So this 48.3 is there for us to stand. Now the question asked is, there is some 60,000 rupees, let's assume, has been disallowed as unproved purchases. Unproved purchases are in cash, so will 48.3 apply? Now if unproved purchases are disallowed means, I'm sure the question of 48.3 application cannot arise, because it will be double taxation, same income. You are disallowing it here and again disallowing it 48.3. You can disallow in 48.3, if you disallow, don't disallow. If you apply 48.3 itself, which will apply only for genuine transactions, those transactions anyway will be disallowed. So that's the answer is very simple. But I will also add that if purchases are unproved, accounts have to be rejected. When accounts are rejected, 48.3 will not apply. I remember in the tribunal when I was working, one of the jewelers cases, mostly they purchase gold jewelry, they purchase, that is a stock in trade for them. Now, many of the sellers don't want, they are ashamed to sell the jewelry. Normally, for a person to sell the jewelry is always a last thing which you would like. So, they don't want a voucher. Very good for them. They feel that they don't have to account for it. But if they account for it, then the 48 comes in. So, whenever you find that most of the cases are unproved, I had decided in the tribunal that 48 will not apply because accounts have to be rejected wholesale. When you keep accounts and when you claim an expenditure, only 48 will apply. I was very happy to find later on MPI Court Purushottam Lal Tamrakar 270 ATR 314 MP that said that if accounts are rejected, 48 will not apply. There are half a dozen tribunal decisions which have taken this view. And now they are, I have listed it, you can get it if you want later. But Tamrakar case, High Court decision is only decision which is of great benefit to the taxpayers. It's better to have your accounts rejected whenever 48 applies, rather than rely upon your account.
So what will be the scenario?
Pardon?
So what will be the scenario when the transaction is out of books, say a bogus purchase?
I have not got your...
If the transaction is not recorded in the books of accounts,
Yes.
whether 48 will apply? It is not
No,
recorded.
the books of accounts are, that's fine. The books of accounts are rejected, 48.3 cannot apply because it applies to a claim made in the account for a deduction of an expenditure. Unfortunately, Supreme Court said expenditure will include purchases also. Which puts us in a complete exposure.
Unrecorded purchases.
Suspicious purchase, bogus purchase.
Yes, unrecorded purchases. If you are making a purchase and you are not recording it, the accounts are absolutely unreliable. No question at all. 48.3 will not apply for unrecorded purchases. One way of looking at it. But unrecorded purchases may be genuine. In that case, it should be allowed. But because it is by cash, 48.3 will apply. Genuine case also. But then if you say, because unrecorded purchases, according to me, will get the accounts rejected. Accounts must be rejected. Party itself, assessee himself says, please reject my accounts because I have not kept it properly. I have not recorded some of the purchases. Enough to reject it. And once you reject it, you avoid 48.3. Tamrakar's case says that a number of decisions of the tribunal are followed or independently have taken the view. That is the only way to avoid an unreasonable law. You are taking an unreasonable stand to see that it does not apply.
Thank you, sir. 270 idea?
Citation Tamrakar. CIT versus Purushottam Lal Tamrakar. 2004, 270 ITR, 314 MP. There are more than half a dozen cases I have given a list. Then business expenses. This again is a repetition of the same question that vehicles registered in the director are a partner's name. Then in that case there is no doubt that depreciation can be claimed by the company or the firm, though it is in the name of the director or the employee. But then the questioner says There is a Mysore Minerals case. You don't have to be even a owner in title, even if it is immovable property. As long as you are the beneficial owner, you have paid for it. Therefore, it should get depreciation. That is the law. They have said it extremely good case. Fortunately, so far it has not been neutralized. Now, the questioner refers to a decision of a tribunal which says, no, a vehicle must be the name of the company itself if it is there. He himself gives a number of cases where that decision is wrong. But still he is agitated and raises the question. It's a question, again, decision rendered per inquiry. Don't bother about such straight decision. You will unnecessarily get blood pressure if you see such decisions and think that some value has to be attached. First thing is that they should ask for a review of the case law apart from going in appeal. A decision rendered per inquirium can always be subject matter of rectification under section 154.
One more question. Sir, one more question.
It's also number 2. If the sale of that vehicle, which is sold by who should pay the tax, automatically, I am saying that it's always the firm or the company who should pay the tax, who should get the deduction. So therefore, under sale, it should pay the tax. If it's a depreciable asset, of course, if it's a block asset, it's a different answer, depending upon whether the block is surplus. Because as long as it's a surplus, no tax. If it is not a part of a block, then naturally you have to pay tax. Then section
23.
Question number 3. This is a very interesting question. Now, conversion of capital asset into stock in trade, 45(2) provides for it. Now, what happens if conversion is of stock in trade into capital? So, 45(2) has been applied. 45(2) can have no application at all. There is no question saying that because their one conversion is taken, tax on particular view is taken, in another conversion a different same view should be taken. But same view was taken in Bright Star Investment Private Limited case. So the question arises on that. The party paid tax on conversion, which he need not pay, because the Supreme Court has said in the case of Kikabai Premchand's case, that it used to be Srin Bhai Kuka's case is what is now part of 45(2). There it is a capital asset converted to stock in trade. They said that there was no conversion. Now it is made for conversion 45(2). Kikabai Premchand's case, it was the case of a reverse case. It was a case of this stock in trade converted into capital asset. They have given a very good example. They have said, suppose a grocer takes something for his own household. What is the value which he should put? Should he put a profit on himself? No man can sell it to himself. So he can only remove the cost from it. That's what he said. I will give another example. A jeweler has got a lot of jewelry. His wife drops in at his office and has a particular fancy for a particular, say, chain. Then, all right, you take it away, he says. Now, what will be the value which you would put? You will put only the cost. That's what he need not sell it to himself at a profit. So, it's a very sound logic. So, in this case, the assessee was offered for tax when it is not taxable by adopting the logic of 45(2), because he was getting a bigger gain. As an investor, he can get the benefit of this paying securities transaction tax. You don't have to pay tax at all. It's a listed share. So he converts it and then immediately sells it. So he says that whether his conversion is right or wrong, whether it could be questioned or not, on the date of transfer, assuming it to be genuine also, there can be no tax. But in this case, tax was levied and the tribunal upheld that tax, applying section 45(2). I feel that the tribunal was wrong. because Kikabai Premchand case, Supreme Court decision squarely on this incident has said there is no tax liability at all. Now, the second part of the question is whether it could be challenged on the ground that it is a non-genuine transaction, applying McDowell's case. McDowell's case is explained in Azadi Bachao and Lawrence case. So I have got a right to arrange my affairs. But if the arrangement is solely for the purpose of income tax, there is no commercial meaning behind it, the senior officer, I feel, can question it. So in this case, what happens in the same year, converts it, or he converts it in 31st March, and 1st April he sells it in stock exchange. Should it be acceptable to the department? Because I have got a right to plan things. I think it does not, it cannot carry conviction because of the closeness of the thing. Suppose that there is if it's 3 or 4 years later, if it is done, it will pass muster easily. So the natural question is, what is the period for which cooling off period for making the transaction acceptable? It's very difficult to say because it's a question of circumstances. But one thing I would like to say is that if such an attempt is made, the department is always will jump to the conclusion the whole thing is done for tax evasion, tax avoidance. But the department at Vodafone case is a standing example. Now when Mohan Balasaran appeared for the case, Vodafone's case, he was giving a talk and he was saying his only regret is he wanted the court to consider the fact that in pricing of the transaction, the underlying assets in Indian shares were to be considered. They are not all written, they said so many things. When I was talking to him afterwards, I told him, according to me, the only defect in the case is they first approved the wrong person. I went to the deductor, the person who purchased the shares, not the person who sold it. And 163 cannot go to that extent, number one. Number two, did they examine anybody? Did they ask the person who transferred what was your intention? The intention, apparently then later on it was explained it is because of the worldwide thing and all that. Nobody was put to question. Mere disbelief, because the entire decision was based upon disbelief. That can never stand. So even in this case, example, I would say, if the assessing officer has not questioned the transferor, all right, you converted, what purpose did you convert? Most of the taxpayers will not be able to say. They will say, my auditor told me. That's why the auditor is also, if a prosecution comes, the auditor probably will have to hang together. But luckily for the taxpayer, the department merely disbelieves all the documents which we made. But mere disbelief, every document must be considered to be true, unless it is disproved. Disproof is possible if the intention of the person who executes the document can be shown to be for merely tax avoidance and not for any commercial reason. So my answer here is that probably assessee may succeed, though he doesn't deserve to be succeed in view of the short duration. Thanks to the department. Actually, can you apply McDowell's case? I would say he has to jolly well accept it if he does not examine the case properly, I would say. Second question is whether any relief wrongly applied, that 35 lakhs was wrongly offered on conversion when Kikabai Premchand states that he should not have done it. Now the remedy is probably 264. You can, if the assessment is already made, you can't file his return, even if it is within time. So you may ask for file an appeal and ask for condemnation of delay. One. Second, you can go for revision petition under section 264 and pray for best luck. That's all. Question is, father-in-law gives a gift to son's wife, and not a gift, I'm sorry, he gives an interest-free loan to son's wife. Now, because it's interest-free, The questionnaire thinks that section 60 would have application. Section 60 says if you transfer an income without transferring the capital asset, section 64 will apply. That is, it will curbing will apply. That's 60. I think that the first thing is that just because interest-free loan, there is no gift involved at all. Why should we imagine that every money which you advance should be always at an interest? There is no law like that. There is no law which prescribes that you must advance at such and such. I remember that interest-free loan when employer to employee, department used to take estimate the interest which employer could have charged but did not charge as that. So one bench of the tribunal had taken the view that it has to be charged. Then it came before another bench of which I was a member, and Mr. C.K. Nair was the other member. So we felt that the tribunal was wrong. So we wrote to the president for constituting a full bench. The president wrote that his view was that the tribunal decision was right. He felt that there was no need for that. So he replied saying that in view of the Madras High Court decision in Lakshmi Finance or something, the Lakshmi Finance case, what happened was same amount was received, was given to some other person. That was a different thing. It was not a case where an employee considers that he must help the employee to acquire his own house property. That's a different matter. It's not comparable according to our view. But when the President refused to constitute a special bench, we decided we were free to take our view. So we deferred from that. Meanwhile, department got better sense. They brought amendment to the rule. Rule 9, they said, you estimated with reference to what the State Bank of India charges. They said, before that it could not be done. Afterwards, our decision was also upheld by the High Court. So this idea that a person must charge interest when he gives a loan is meaningless. Interest-free loan is a normal character. You need not be a Jew or a Muslim to see that it's a sin to charge interest. It may not be a sin, but charging interest, I think, why is money lending profession always hated? Because charging interest is considered to be something wrong. Of course, we have now realized that all banks do that business. Reasonable charge of interest is good for it, helps the economy, but it's a different matter. But the answer here is section 60 will not apply because 64(1)(6) itself provides that if you make a gift to your son's wife, automatically the clubbing provision will apply. It talks only about a gift and not a loan. That answers the query.
Now, please come to question number 25. Interesting question. Here, as I understand it, the books of accounts, the balance sheet and P&L account of the company, presumably approved by the shareholders, is not correct because of certain bogus purchases. Now, those bogus purchases taken into account will affect the loss return for the purpose of Income Tax Act. But the question is it obligatory on the part of the company to recompute to increase the book profits? We had a similar situation which is now pending in the AP High Court for Satyam, where for several years bogus income was being recorded, and what raised the question of recasting the books. And there, what we found was that there is no provision for redoing the accounts, but Accounting Standard 5 talks of preparing prior period expenses. And what we have done for Satya is all those bogus incomes which were recorded are now taken in the final year after they appointed the new auditors. They went into all books, account has been approved, payments have been declared, everything is over. So the view taken was that there is no need to disturb those accounts. In the data book, or there is a separate entry or separately for prior period items. Now, I examined Ramaya also. There is no provision for recasting the books of accounts. We have recast the books and approved by the shareholders. If the purchases are bogus, you have to only make some adjustment at a later point of time, but you can't now reopen the books. Then as far as this question is concerned, the question is with regard to, is it necessary, is it mandatory on the part of the company to recompute, increase its book profits? The answer is no. And you see, because as far as the Companies Act is concerned, the shareholders have approved their accounts. Now there is a question of recomputing it. Though in Satyam we have taken the view, this issue is not completely free from doubt. If the accounts are known to be wrong, in my view, there is no harm in the next AGM recalling the thing and saying the particular day. The whole thing is completely in a grey area. Suppose the accounts are approved for this year, and after 2 years discover that some accounts are bogus. You can't change the account. That's the view. If you are arguing in the High Court in the Satyam case, and we say that the remedy is to go by years 5 to make for that period adjustments. As far as auditors, what will happen is the income for the purpose of income tax will completely change. But as far as the balance sheet and books is concerned, that will be the same. But this definitely won't lead to a problem. Because what do you do in such a case? You say the book profit is per and nothing is to be, can't change it, or what is to be done. If you go by the Satyam logic, then you can take the prior period adjustments and file a revised return for the lower loss, which is the income. This is exactly what we have now done. And one difficulty in Satyam, the major problem which is arising in Satyam is, what they say is, if the assessments are reopened, no benefit can accrue to the assessor. What we are now saying is, if you are saying that my income is completely bogus, then you also knock out that TDS. Both has to go. You can't simply say, I don't go to complicated facts. See what happened in Satyam, if I will just take 5 minutes to digress, is because fake fixed deposit interest was being shown as income, that would be taxable. Now, how to offset the tax? They started showing fake foreign income on which their tax credit certificates. So if I got 100 crores of fictitious interest income, I take 90 crores as fictitious tax credit certificates and reduce 100 crores to 90 crores and pay tax on 10 crores. But actually there is no 100 crore income, there is no corresponding foreign income. So that has multiplied over a period of 5 years to, according to the CBI estimate, it is 5,125 crores, according to the other, 4,900 crores. Now what the department is doing, they say that whatever bogus income you have shown will continue to tax. But the tax rate will not allow you. So we tax you 100, but we will not allow you to take away 90. He said you disallow both. If you say that if I say my house property is there, and it's not my house property, and I also pay municipal taxes income, you must disallow the income and also disallow the expenditure. You can't have a halfway transaction. They are relying on Sun Engineering to say that no, reopening assessment can be only for prejudice to revenue. As far as SSC is concerned, we will not be any benefits. That is the entire issue pending. And we have taken the plea that if the accounts are initiated by fraud or forgery, then the accounts are nullity. And the whole thing has to be recast for the purpose of income tax. So one more thing I just mentioned, you mentioned about, just go to question number 22 on the judicial propriety. This is a persistent problem. If you want the landmark judgment of Kamalashi Finance, AIR 1992 SC 711, where they very strongly, just another judgment, where he mentions the importance of judicial discipline, following proceedings and so on. And one conflict which frequently comes, the tribunal is in Mumbai. What is the effect of a decision of the Calcutta High Court? Is it binding on the tribunal in Bombay or not? So the answer to that is in the Bombay High Court judgment of CIT was Godavari Devi Saraf, 11KITI589. It says that if it's a central statute, then the judgment of any one High Court is binding on authorities throughout the country. Unless then only controversy comes, the conflict judgment, then what happens? That's the only conflict. But if there is no conflict judgment, then Godavari Devi Saraf says that if one High Court, in that case what happened, the Madras High Court had struck down the old 140A3 that Sai Mahipur's case had struck down that self-assessment provision. The Bombay authority said it's a Madras High Court judgment, I'm not bound by it, because Madras High Court applies only to Madras Tamil Nadu territory. The High Court said no, if it's a central statute, that's the most important. If it's a central statute, then the judgment of any one court is applicable on authorities throughout the country.
Sir, air citation.
AR 1992 SC 711. We have dealt with it page 33 and 36 also. This problem particularly happens in India. Last year, yesterday also they created a Madam Trust where there is a AR ruling of Justice Pasai with regard to the Bombay Customs. The Madras Customs says you will not, that's for Bombay Customs, therefore Madras will not apply. The